It's 2020 and currently the world is experiencing a crisis like never seen before. The coronavirus has rapidly spread across the globe, collapsing industries, hospitalising thousands of people and resulting in many fatalities. It is now that we've decided to start the Skadi podcast to help those in the financial services navigate this very uncertain future. In our second episode, Nick and Damian look back at some of the crises they've traded through in the past and what their ramifications were from a behavioural and regulatory perspective. If you like this podcast, don't forget to subscribe and share with your friends.
Okay, so this is the second episode of the Skadi podcast. We are, as everyone is, working from home. Skadi, as you know, is a company that provides subject matter expertise to control functions within financial institutions. We are generally ex-front office professionals, and we help people in the internal audit functions, in the compliance functions, understand the activity of front office staff in order to help them control those businesses better. We also conduct investigations, expert witness work. So for the second episode, what we thought we would do is draw on the experience of Damian Taylor and myself, who both have over 20 years trading experience in the financial markets, and really to look back at other crises that we've traded through, and really sort of do a kind of compare and contrast and see what it looks like relative to the present situation that people find themselves in. And then also to look at the present situation that people find themselves in. What is it like at the moment trying to run a desk in this environment? You know, are people working at a disaster recovery site? Are people still operating within their firm? Are they operating from home? And what do those different environments, present in terms of challenges? And how have people been getting on continuing business? So that's the subject for tonight. I'll just talk to Damian now. So Damian, thinking back to your career, what do you think has been the worst market environment you've traded through?
Can I think of the worst? Well, obviously, to not be trading this one has been quite odd. I mean, obviously, we see the headlines and I still keep an eye on some of the charts. And it's been, I think it was a pretty frenetic week whenever it was, beginning of March. A lot of people had it handed to them, as it were. But I think going back, I mean, I just started my career, sort of 96, 97, coming into the Asian crisis. So although I wasn't trading it, I was actually quite exposed to it, I suppose, because in fact, I started work at a place called Caspian Securities, which some of you may know, probably many don't, but it was set up by a guy called Christopher Heath, who set up Bearing Securities of famous Bearings and Nicolas fame, although nothing particularly to do with that. So Caspian was an emerging market focused investment bank set up, I think it was probably about 95-6. And I started working there in 96, and sort of 97, well, middle of 97, something called the Asian financial crisis hit. And I think that was, I mean, I think people are trying to, scrabbling around to try and compare what's going on at the moment to history. And certainly for the Asian countries themselves, I think the Asian financial crisis was a big shock. I mean, I think GDP in some of these places fell 30-40%, which is just sort of the numbers that are being thrown around now. So, I mean, you traded it itself, Nick. Am I right in thinking you were trading through Asia?
Yeah, I had literally started trading, I think, 12 months before. So it was very new to me. And in fact, I was sort of on the cusp, as anyone who starts their career, really, I was on the cusp between a bit of research, a bit of trading. You know, I was sort of getting my, I had the stabilizers on, if you like, on the bike. But I remember it very, very well because it was, a big part of my career. I just joined ING Bearings Financial Products, who, you've mentioned Bearings, and obviously they blew up after Nick Leeson's activity in 95. And so working there in an area where they were trying to rebuild a derivatives business, and probably the benchmark was set, I think, a lot higher for them than for other places around the street because they had such regulatory scrutiny. So really, I was enjoying working with a group of professionals, many of which who came from Bankers Trust, some that came from other great banks as well. And there was a lot of the technology that they brought with them, and I really had a sort of sense of being in the heart of something where, everybody really understood risk and was managing risk well. And then the crisis came along, and what was amazing then, I remember, was that trading generally was done on the basis of overnight funding. Traders were funding their books, or I don't think even traders particularly gave much mind to it. I think most of the funding was organized by product control in the finance area, looking at the balances on the books. And there was no real consideration given to, what was the maturity of a trade. It was just the idea that you had this risk on your book overnight, therefore funded overnight, those rates were fairly stable. And of course, when the Asian crisis hit, and it was very much a currency crisis because, people were, using, as I recall, people were sort of short selling the stock market, realizing currency as a result of that, and then selling that currency in the marketplace to get back dollars. So there was huge pressure on the currencies as well as the stock markets, and it was a kind of self-perpetuating cycle as more of this occurred, this activity. And the local central banks really jacked up rates to defend their currencies. And, we always think in terms of crises that rates are going to fall because that's been the activity since 2008, that rates get absolutely collapsed, almost go negative in order to stimulate the economy. This was a very, very different scenario. They were desperately trying to defend their currencies. And so overnight rates went up, and people were really caught unawares by that. And I think that was one of the big learnings that occurred at the time, was that traders were then, I certainly know we brought in cash management by book, where traders were looking much more at the balances they had and giving much more consideration to the term funding that they needed, whether they had 3-month trades on 6-month trades, 1 year, whatever it happened to be. And so that became a much more efficient way of managing those balances, on the book. And you really had to think very, very carefully before organizing your funding. There were some very interesting situations. I remember one morning, close to it was the day before the expiry of the Malaysian futures contract, and the Malaysian futures were at a discount of 10% to fair value. And I remember running around to my boss at the time, all excited, and saying, have you seen this? Have you seen this? We need to buy some. And he was very excited by this idea that we go in and buy these futures at a 10% discount to the cash, because the market would have to fall more than 10% for us to lose money. And the very next day we came in, having managed to buy about, not very much, I think about $1 million worth, something like that. The Malaysian stock market did indeed fall 10%, and we didn't lose, we didn't gain. It fell to meet where the futures fair value was. But great fun and a great learning experience all the same. So that was really, I think, the big one for me right at the start of my career. And then, of course, we followed straight on from that into the Russian crisis, and you and I were trading together at that time because we were on the country funds desk, trading investment trusts and hedging those through, what futures contracts were available. And there wasn't a lot of short selling allowed certainly in the Asian markets because of, their fear of short sellers from the year before and so on and so forth. So futures were really the only way to get short. And that meant futures were certainly trading at a discount. So you had to sort of bring that into your valuation. And can you remember when we used to look at those investment trusts and those funds, that we would try to get a feel for, what the NAV was going to do? We'd run all kinds of correlation exercises and tracking error exercises, so that we can try and predict, what the market, what the investment trust would do relative to the market. So work out the beta, but also, the right hedge ratio for us.
Yeah, I mean, you look back at it now, and we'd like to think we were relatively cutting edge with some of the technology we were employing to try, yeah, as you say, to predict NAVs. Obviously, the interesting thing about these closed-end funds or investment trusts was, they can trade at discounts, and boy, do they trade at discounts when things start to go wrong. I mean, we've seen that recently as well with investment trusts, and in fact in ETFs, which theoretically shouldn't be moving out very far from their NAV, but. Yes, I do remember there were I don't know if you remember the Regent Red, White and Blue Tiger funds, which had been sort of launched to great fanfare and had gathered a lot of assets because Russia had been a very hot market up until that point. And these things have gone up a long, long way. And yeah, so as a trader back then, you were relatively happy to run these things on your book because normally, you get hit by a client, run them for a few days, few weeks, and they tend to be one-way trades. But as you say, when the crisis started to hit, it was hairier. And actually, the fact that there weren't many products that we could use to hedge these things out. Certainly, there was nothing like an ETF or anything like that back then. I think there was some. I think UBS had some structured products that we could use, and I think there were futures. I can't remember how liquid the Russian futures were, but yeah, we could. We'd be hedging out with those, and you'd sort of hope that you obviously you're hedging the NAV, but the price can move a lot further than the NAV. So you're sort of it's protection to a degree, but it's much better to have something out there rather than nothing, obviously.
No, I mean that's a good point because you can only hedge so far, and there are idiosyncrasies. And I also remember that at that time a lot of the funds didn't produce their full weightings of what they held. They would produce like the largest 10 components.
Yeah.
So you
was all, yeah.
So you'd have like maybe 50% or 60% of the capitalization of the fund in front of you. And of course there were the dreadful problem were these Russian GKOs, which were the Russian debt that they were due to default on. And a lot of these funds had been buying them for excess yield because they were cheap, and then they wouldn't show up in the top 10 holdings, but nonetheless they would be a significant holding, and the NAV would come out with dreadful performance, and then they'd have to confess that they had this holding of GKOs, and then nobody would want to purchase the paper. So you were left with a very, very difficult situation. So I think post that crisis, certainly the transparency around holdings and the scrutiny around holdings was greatly increased as a result, and that's all to the good as well. So yeah, I mean that was certainly something to work through. I think 2008, which was such a huge crisis. Where did you find yourself during that era of the market?
So I was at that time. I'd moved more to the hedge fund side of things. So I was at a place called Matrix Alternative Asset Management, and I sort of sat in the middle of 4 hedge funds, one Asian focused, one Russian focused, East European focused, and one West European focused, and then a sort of systematic fund that we were looking at to get off the ground as well at the time being. But I mean, that was, yeah, so I was trading the markets, and I remember some frightening days of short selling bans being imposed, UK banks gapping open 100%, up 100%. And we were long these things in very small size, but it did make you think. I mean, everyone sort of assumes that a crash is just one-way traffic down, and a lot of days are, but there are some vicious upswings within that. We've seen that actually recently here. The S&P I think has bounced 25% off its lows in 2 weeks. It's been the fastest fall and then the fastest rally. Obviously, we haven't made all of it back by any stretch, but I mean, I remember, because it was such a financially driven crisis, and I was working at a financial institution, it was, it wasn't particularly petrifying from a trading perspective. I mean, there were a lot of risk parameters overlying what we were doing, so we would, you were swinging in very small or minimal size at that point of time. But it was waking up in the morning and thinking, I think we, as a firm, banked at RBS, and that sort of worry that were the firms, was the firm cash reserve good, as it were, and were you going to get paid? That sort of real fear. I suppose it's possibly like people are feeling now. I mean, it feels like now is a sort of agglomeration of all the crises we've seen. But
was that because you were prime brokering with them, or what was the situation with RBS for you?
No, I just think they were that was where Matrix held its bank accounts, literally where you got paid from, etc., etc. It wasn't. I mean, that was not necessarily a trading thing. It was more, that concern that the firm might be on sticky ground or not. It turned out to be okay at the time, but it was more, would you get paid? Was the system about to gum up and you were just going to be stuck, expecting a salary to come in and bills about to come out, etc., etc. So that sort of feel. I mean, were you in Asia at the time? You were trading through it?
I was in Asia at the time, trading in convertible bonds, and I think funnily enough, Asia had been lucky in that the year before, or 2 years before, there'd been a mini credit crisis in India. And so everyone's books, I think, were reduced relative to the rest of the world. And there was, slightly more awareness maybe of what difficult market conditions could be. And Asia, in the convertible world, again, it all goes down to hedging, Damian, and we didn't have the tools at our disposal, particularly to hedge, because even that late, you still had markets where stock borrow was difficult to come by, and there was a lot of macro hedging through the futures and other various products, single stock futures and so on, thinking about India. You also had very, very long conversion periods on Indian paper. I remember it would take about 45 days between you putting your conversion notice in on an Indian convertible bond and you receiving stock. So you've got to run that risk for 45 days. That's a hell of a long time. So these things would tend to trade at big discounts when they got up, deep in the money to reflect that risk. So it was very, very difficult trading at that time. But I think the hardest thing about it was that everybody was in the same boat. Every convertible bond account that we spoke to, every money manager was facing people that wanted to redeem out of their funds. And so they were all trying to raise money, and it was very difficult, in fact nigh on impossible, to find a buyer for any piece of paper. And of course you start off in the crisis, very early days, not really understanding the situation. So as the bank, you're standing up there and taking paper off customers because you're waiting for the next person to come along in a few days, because that's what you do in a fairly illiquid market. And of course, after a few days and then a few weeks and never seeing a buyer, you suddenly realize the maelstrom and the problem that you're in. And what we really had to do was really try and figure out this market and work out how to unlock it, how to determine who the buyer could be. And there were really only two routes that were identified. And the first one was, because it was if you like, a kind of a cash crunch crisis for the money managers, rather than a solvency issue for the issuers. If you were fortunate enough, you could probably return to the issuer and sell them back the paper that they'd issued cheap, and they could cancel the debt. That worked in some circumstances, but they would also, there would also be people that weren't that solvent and probably needed to refinance. So they weren't interested, even at great discounts, of buying back their own paper. The other thing was identifying that as these convertible bonds fell and they were trading like stock, and they really were, the bond floors didn't kick in at all. They were kind of like bond swimming pools, if you like. Then you were looking at the fact that convertible bonds rank higher up the capital structure than stock. So if you could find an equity holder that held the stock, you could get them to switch into the convertible bond, because if everything really went wrong, at least they'd have some kind of recovery value. And that took quite a while to unlock that market. Plus you had all of the the typical difficulties of, you might find an equity holder, but their mandate didn't allow them to buy convertible bonds. So it didn't matter how compelling the switch was, they just wouldn't be able to make that switch. So that was, very, very tough, very, very difficult. And I think, sitting in that market at that time, I really felt like I was in the front line, the kind of the firing line of everything. And I think looking at this crisis now, I'm sure it's difficult and hard being on a trading desk, but the traders are not in the firing line. We know that. The medical professionals are the people that are in the firing line. And I think it is, it is not just interesting, but I can have some empathy, I think, with the astonishment and anger that they have when people aren't social distancing, when they see them out in the park. And I get that, because the people in the park just aren't seeing what those people are seeing on the front line every day, the horror that they're seeing, the difficult workload they have. And in a similar way, back in 2008, I'd come out of work, and my friends that were pilots, working for Cathay Pacific and Dragonair, they just didn't see what I was seeing every day. I knew that there was this crisis coming. I knew that they weren't going to be, flying their planes as much in the next 12 months because there just wouldn't be enough money around. But they just couldn't see it coming. So it is difficult. And obviously, we could talk about the controls that came in after the 2008 crisis, but I think that they're well known. The Volcker review and so on, and what that's done for taking proprietary trading out of banks and so on and so forth. So it's going to be very interesting to see what controls come out of the marketplace that we find ourselves in now. I think the sort of the big thing is going to be the moratorium, if you like, on the lending scheme to small businesses, because that's in the UK certainly really struggled to function and struggled to get going. And it certainly, it seems you can hear that the narrative is turning on the banks, really laying the blame at the banks, not the fact that the procedure or whatever, the scheme that was put in place by the politicians was very, very difficult to follow. You can see very much that they're just putting it down to the fact that the banks are being very slow to process and understand. And I think that's a very sharp contrast to 2008, where, one of the big problems identified was the lack of regulation and low touch regulation. And that's why regulation, rose up so much with a vengeance. And now you have a situation where the banks are, trying to behave in a regulated fashion, trying to behave in a prudent fashion, and are getting criticized for that. So that's a kind of an interesting paradox, I guess, between the last two crises, if you like. But you've been doing a bit of a sort of check around the marketplace. What are you seeing in terms of the way people are working out there? What's the modus operandi for people trading now and other front office staff?
Yeah, so I thought it would be instructive. Obviously, we now don't work on the front line, as it were, ourselves, but we still know a lot of people in the markets. And actually, I've phoned around a fair few ex-colleagues from over the years, from over many years, working in various roles, either sales, trading, research, buy side and or sell side. So nearly everyone, that's not quite, nearly everyone I've spoken to is working from home, which I was surprised by. I thought there would be maybe a few more in. Most people I've spoken to, a lot of people confirm their entire offices have been shut. Some have sort of gone there as a skeleton staff in there. But the bulk of people have confirmed that they're working from home, and a lot of hedge fund people I've spoken to have said their counterparties tend to be working from home as well. So
is that uniform regardless of the size of firm? So if you take like a big tier one investment bank, is everybody at home? And then when you look at a kind of a more mid-size, third line kind of operation? What's going on? Is there any difference between the two, or not really?
There's a bit of difference. I mean, I think the small mids tend to all be from home, and then and then within the mids, there are some. The guy I spoke to over actually in Milan, interestingly, said he was in, and there were, I think, of an office of 150, there were about 10 of them in, which were, a couple of sales traders, a bit of IT, and I can sort of understand IT, and actually, interestingly, a bit of operations. I thought most operations would be from home, but I suppose I get that it's useful to have people, because obviously some of those lines on the into Crest and such are, it's probably easier to be in the office to be doing that. But everyone I spoke to had confirmed they were on secure lines in. They hadn't just downloaded the software and gone. They'd have to log in remotely to their office network, and then before they could get going, which would make a lot of sense from an IT security perspective. But obviously, a lot of people were concerned that they are on home broadband, and we see it. My broadband's gone out for an afternoon. If you're BT or Sky, not particularly signaling them out or anything, but there are outages here and there. And if you're part way through a trade or part way through a deal, or waiting to confirm something back on a Bloomberg chat, which obviously is recorded, and your internet just goes, that's problematic. And then you're picking up the phone. I think people, in an office environment, the problems crop up. They do all the time. Things get misbooked, or someone misplaces a digit on a trade or whatever it is. But you can get people together in a meeting room, discuss it, go back to a client very fast, etc., etc. I think this whole modus operandi. I mean, people have been surprised that it has worked better than they thought. But when a problem occurs, it's harder. Even getting 6 people on a Zoom call. If you need to talk to someone urgently and people are having to mute in, mute out, etc., etc. I think that's a difficulty that people have faced. And actually, speaking to a friend, he'd said that he was still trying to deal with they'd been slightly left on the hook on a trade. The confirmation hadn't gone out properly or whatever it was. It's that you need to, do you have to make the client good? I mean, some people have said actually clients have been a lot more understanding, so it's been fine. Some people have gone, we've been hung out a couple of times, and that's just how we have to deal with it. But yes, I think
that's an interesting point, because you are going to get that polarization. You're going to get those customers that are going to show a lot of empathy, that are dealing with the same sort of situation. And then at the other end of the scale, you're going to have situations where people are all losing money and they're under pressure and they're fighting for their lives. And that's when things get very, very difficult and very, very ugly. And people start becoming very, very demanding on fills and so on and so forth. So there's a lot of, there must inevitably be a lot of pain and a lot of hurt out there when markets have done what they've done, the recent performances.
Yeah, I think that absolutely that's true. I mean, I think if you'd asked people 3 months ago, could everyone go and work from home? I think a lot of banks sort of just put up their hands and gone, no way, we can do this. And I think the fact that in fact we have got to this stage where it has worked relatively seamlessly is incredibly impressive. And I think if this crisis had occurred 10, 15 years ago, the infrastructure just isn't there to support that. I mean, we talk about what will come of this, and it's very hard to start guessing a lot of this stuff. But certainly, a lot of these banks invest a lot of money in disaster recovery sites, and you've got to call a lot of that into question, because why would you be paying the rent? I mean, on a warehouse, it may not be anywhere particularly flash, but that's a big number. I assume you pay out and you send people there every other week to test, et cetera, et cetera. It's been shown that people can do it from home, and I think, speaking to some people, they were like, there has been chat in the office, well, not in the office, over the email, that in fact, when things return to normal, in inverted commas, that maybe a trader or two works from home as once a week, just as a well, not as a perk necessarily, but just as a way to make sure that the system is always set up that you can do that without having to send people off to disaster recovery sites, et cetera, et cetera. So. Yeah, it was an interesting phone around to speak to.
And what do you think? I mean, I can certainly think, you know, areas of risk coming up. You always find things out. I remember, when we were trading, you always discovered stuff in the run up to settlement, because of course that's when you've got to get everything into line, and you're going to pay your balances and etc. And certain things that trade on longer cycles, or thinking about futures that have their kind of monthly expiries or quarterly expiries, you can have situations where if you haven't had the proper reconciliations in the books, and I imagine reconciliations at the moment, probably at this moment, are probably quite good, but I reckon in the first few days of the transition across must have been pretty difficult, very, very challenging. That's really when you find the situation where the positions in your book are not as you see them to be, because there are certain trades that haven't got booked, or there's a checking query versus a price or an amount that's been dealt, etc. I think those are going to be the interesting sort of scenarios that occur in the next few weeks as people gradually get into resolve positions. And I think given the problems that numerous banks have had the last couple of years on their own resilient systems around transaction reporting and trade reporting, when we move to a off the floor home environment, I would have to send control staff immediately to transaction reporting and trade reporting, just to check the resilience of that, because I think that's certainly in an area that could be a problem for people. Again, thinking back to where Skadi's worked on audits and where we've uncovered questionable activity, let's say, I think control staff always have to have their radar out, and I know the good ones do, against any suppression activities. So where traders have arranged with operations that they can suppress the reporting on this book because or reporting of these features of this instrument because it's blowing up the risk report or whatever. I'm thinking about stuff trading near barriers and stuff towards expiry, where all the gamma gets really, really large. It's those kind of workarounds that may have been put in place as a kind of temporary fix, just so people can get things functioning in this new environment. That's where I think control staff have got to be really on the ball to really go through operations in the aftermath of this, just to make sure that everything's nailed back down. I think you can give people leeway for a little while, but certainly once we're getting a few weeks into these things, I would be encouraging them to go through and look at these kind of areas for problems. Yeah. Anything that you've experienced that you would direct people towards thinking back?
I mean, yes. I mean, everyone I spoke to was obviously still on recorded lines, or would claim they were on recorded lines. I think some people are more ahead of the curve than others. So some people I've spoken to said, yeah, we've all got IP phones anyway, so literally we can go home, plug an IP phone in, and all those lines are recorded.
What's an IP phone to an old timer?
Well, I think it's Internet Protocol. I mean, it's just basically a phone that works over the internet rather than over the line. So I think all that stuff can be recorded, backup base, as it were, rather than going, we're going to record it remotely and then you have to send that in. I mean, that would raise big alarm bells. Nobody I spoke to said that. I mean, I think some people said they had their office lines diverted to mobiles, but they were being recorded as part of that. And some would say actually they'd put an app on their phone that then would record stuff, which I would be slightly more concerned by. But I think people generally are aware of this, and I'd always want a recorded line, because you always want that backup of when something goes wrong, that you can go back and pull a tape and check that what you said and what you said was very clear, etc., etc. But I would certainly, yes, if anyone has come along and said, I've had an issue with a recording of a line or something, that's the sort of thing you've got to keep a very close eye on. A lot of a lot of stuff gets confirmed back, I think, using Bloomberg in Bloomberg chats and stuff. So I think that's another route that you would check, that people were confirming that route as well. But
And what do you think about? I mean, obviously, we talked about the move to cash management by book and so on. Has anyone talked to you about the transparency of not transparency, but the kind of the difficulty in getting a handle on the book? Just seeing the positions and in the first few days, whether they were able to see what they had, the risk that they were running, but not just that, like the cash balances, because if you're trying to work out your funding that you need to arrange at the end of the week or whatever, whether any of that was problematic in the first few throes of this crisis as everyone moved off grid, if you like, whether it was possible to see stuff, because I think that would be, again, an area where there may be a number of unticketed trades as with regards to funding, etc. And probably FX as well, cross-currency risk as well. I mean, we haven't seen too wild fluctuations on currency. I mean, they've been volatile, but it's not been too crazy out there this time, has it?
no, FX has been, in inverted commas, orderly compared to some of the moves in some of the other instruments. No, I mean, I spoke to someone in market risk management, and he was. I think the problem with working from home is quite often you're dealing with big files that you would look to reconcile, and in fact, if you're in the office, getting hold of that data is you can download a big file very easily, and he was much more. I have to download these things early in the morning before before the States gets in, really. Just from 2:30 onwards, generally things just feel a bit slower. So I think,
or before your daughter gets going on Google
yeah,
Classroom,
well, yeah,
I've found.
exactly. So there's, from a risk perspective, I suppose. Whereas you might be able to run big files and big processes, batch processes in the office, that's harder over a thinner pipe back into your house. So you've either got to go look. We look at things on an hourly cut, or a 4-hour cut, or an overnight cut. So I think from a trading perspective at the cutting edge, you try and keep things as efficient as possible because you want your live data feeds to be up to speed, etc., etc. So yes, people might not be downloading all the books because they might just go, look, I'm trading this book X, and actually that I just need my positioning on that. But I've got to remember to go back and check, did I flick stuff through to a management book or whatever it is. So it's you need to have a big understanding of that structure of where all the books sit together from an auditor's perspective, to be able to go, okay, actually, who has access to all these books, and is someone that we would normally expect to be booking to that book not, or are they booking a lot to that book that they weren't before, or whatever, that sort of stuff.
Yeah, no, I think you're so right. I think you're absolutely bang on. I think books and records, as a kind of matter of urgency, kind of for the first month of going through this, there just has to be such scrutiny around that, because people have got to be able to reconcile the balances that they're trading, things that they're settling, and like you say, the market risk reports, there will be a certain amount of triage done, right, where people will have just gone, right, we're going to just go with what we think we have, and small amount of files just to get through the process. But if you do that, you're bringing in risk, right, into the process.
Yeah.
And risk that you're overlooking stuff. And the business of finance is very, very complex, or it can be very, very complex. And there's certain businesses and products where that's quite a tough call to make, between having all of the the risk metrics in front of you, or just going with a few of the major ones and just saying, okay, we need to just do this to get going and get on with the process of servicing the customers, etc. So it's going to be a very challenging time, I think, for people, very, very much so in the next few months.
Thank you for listening to episode 2. Stick with us on this journey as we, like many of you, are trying to navigate these very uncertain times. This is the Skadi podcast.